Welcome back to Young Bucks. This week we'll discuss a survey of millennials from Wells Fargo. We'll get some hot takes from Ben and Matt, who just attended the Great Investors Best Ideas Conference in Dallas. And we'll also take a look at the data revolution in Major League Baseball. Thanks for joining us.
Hey everybody, Andrew Hall here. Joining me today, Sam Frost. Sam, how's it going, man?
Going well.
Good. Today we're going to talk about a survey about millennials, everybody's favorite topic here on Young Bucks. But this one's actually about millennials and money, especially their views of money. So Wells Fargo Fund Advisors. So Wells Fargo, we know the bank. We're actually shareholders in the bank itself, but they have all kinds of little divisions there. They've got Wells Fargo Advisors, which is kind of investment advisors, people like us that give you advice. They also have fund advisors, so basically people running mutual funds. So Wells Fargo Fund Advisors did a survey. They surveyed a little more than 1,700 millennials, particularly between the ages of 20 and 36. So I think the millennial demographic is actually a little bit wider, goes younger, but they did this group of people, and they asked them a bunch of questions. So we're going to dive into some of their observations and kind of talk about it. So the first thing that I thought was really interesting, how unique millennials are. Millennials, according to this survey, this is just one study, but it says that they care about their relationships, their purpose, and their financial wellness. So Sam, can you relate to that at all?
Yeah, I think I also care about all three of those.
Yeah, it's weird. Me too. I guess that's what makes us millennials.
Very profound.
Yeah, interesting stuff. Also says that they are, quote, happier when they take control of their financial lives.
Which is going to be very interesting when we read the rest of these numbers.
Yeah, because interestingly enough, only 3 out of 5 millennials are happy and find their life meaningful. So 40% of millennials in kind of a dark spot. I don't want to make too much light of that in case that number is actually accurate, but hang tight out there, everybody. A lot of unhappy millennials out there. I'm going to go through a list of things, and Sam, give me a yes, give me a no, give me some feedback as to whether or not you care about these things, okay? Right. First up, do you care about feeling mentally and physically healthy?
I mean, you tell me.
Obviously. I care about you feeling physically healthy. Do you care about making a difference for the greater good?
I do.
I mean, that's what this podcast is all about.
Yep.
Do you care about feeling financially secure?
Of course.
Do you care about...
That's why I'm here.
Yeah. Do you care about having fulfilling work?
Of course.
Also why you're here. Do you care about having close relationships?
Yeah, our relationship means a lot.
So those things, 9 out of 10 millennials care about all of those things. So pretty interesting data.
So I'm like
the
here. Status quo.
Yeah, you're such a millennial.
Such a millennial.
The things that you care about are so millennial of you. 9 out of 10 humans, I think, also care about all of those things. And probably a decent number of animals, maybe with the exception of financial security. Most of these things are pretty true of all humans. So congratulations, Wells Fargo Fund Advisors. You've determined millennials are living beings. What's interesting here, though, is some of the financial data. We're done with the snark, at least for the most part. Talking about millennials and some of the challenges they face as they kind of come into age in which they're saving, investing, things like that. 7 out of 10 millennials that were surveyed say that the recession made them skeptical of the stock market, which I think is an interesting point. We've talked before, I know we talked about this on the very first episode of Young Bucks, that there's a lot of money, so to speak, parked on the sidelines for millennials, and it sounds like maybe this is a big reason why.
Yeah, and so it makes a lot of sense because if we're running up to, I think 36 was the top end of this study, those guys were either, fresh out of college or, just about to enter the workforce, and all of a sudden it's like, oh, there's no job market, and so it's a little a little scary at that point. And then especially the guys who are like 34, 35, 36, now those guys were in the market, they could have, or in the job market, they could have already started investing. Maybe they opened up a Roth IRA, 401k or something, and then like the first year out, bam, you lose 40%.
Yeah.
So that is definitely understandable. I'm actually a little, I guess 7 out of 10 for that age range is probably pretty accurate. I might have even thought it would have been like 6 out of 10 or something.
42% of millennials rely on other people for direct financial support. So maybe that's, hey, mom, hey, dad, I need money for rent, or a boyfriend, a girlfriend, somebody like that, grandparents, whatever. I need this money. So I thought that was an interesting thing. You know, I think the stereotype is that 100% rely.
Yeah.
So 42% was actually a pleasant number, especially when you take into account that some of these people are 20 years old.
Yeah.
I know I was depending on my parents when I was
Yep.
20 years old.
And that definitely makes sense. When you start running up to 36 years old, like you would expect at least half that group is getting, like the kids in college, probably 100%,
Right.
you know, for the most part.
Yeah.
Not to insult anybody who's working and paying their way through college, but
Yeah, absolutely. 98% say that feeling financially secure is important to them, but in contrast to that, as Sam just mentioned, only 32% are satisfied with their financial lives. And what's interesting when you start to dig into that, you start to think, okay, well, how can they become satisfied and what's making them unsatisfied? The three most intimidating money topics, they said, you know, the three things that are stressing them out are saving for the future, sticking to a budget, which I think are, you know, in my mind, those things go somewhat hand in hand. But, you know, I guess the budget is kind of the means to the end. And knowing how to invest, which, to be totally honest with our listeners or viewers, whatever you may be out there, that's a big part of why we started this show.
Yep.
Like those three topics are things we want to address. So I thought that was interesting. 77% do not have a financial advisor. That's interesting. We've talked a lot about that kind of internally, just in terms of wanting to serve young people and how it's actually, to be totally blunt with everyone out there, that's a great opportunity for us, for our business, because we know how many millennials there are, and we know that they're going to continue to accumulate assets.
Yep. So it's a very interesting time period, I feel like. And, you know, I haven't been investing long enough to have seen all the ups and downs and how this happens, but I could imagine if I was 34 years old and was really affected by the financial crisis, I probably would have done the same thing had I not jumped into this profession. But, you know, you had the crisis. People lost a lot of money. Maybe you mentioned earlier you saw your dad lose a lot of money,
Right.
your grandparents, people close to retirement losing money. And so you're a little skeptical. Does the financial markets, do they work? And then something else is, well, only 32% satisfied with their financial lives. You know, wages have not been growing over the past 10 years.
Right.
I think we're finally starting to see, you know, inflation pick up. Wages are starting to grow a little bit. Unemployment's dropping. Like, all this good stuff's coming together. But, like, it's taking a long time for that recovery to happen, way longer than usual. And so you have all these millennials who are in a tough situation. And ideally, and again, this is part of the reason we started the show, our focus on helping millennials and serving millennials, is it would have done this whole age group a lot had there been, you know, some advisors who had reached out to millennials to say, hey, you're young, this doesn't even affect you. Like,
Right.
yeah, so you put $5,500 into your Roth IRA last year, now you have $2,500. Like, yeah, that
Grin and bear it.
sucks, but it doesn't matter. You
Right.
can't let up. You got to keep investing, keep pouring money in. And so I think you're right. It does open up the, you know, discussion of how valuable it is for advisors to reach out to millennials and actually being able to help people.
Yeah, and I think that's a great segue. We're speaking at the Schwab Impact Conference, which is a big kind of nerd conference for nerds like us that work as investment advisors in a couple weeks. So we'll probably have some coverage of that on Twitter and maybe some videos and stuff like that on YouTube. We'll see what all they let us use. But, you know, really the topic that we're trying to encourage other advisors to pursue is that they should be reaching out to both millennial employees and millennial clients. And the reality is if you're a millennial out there and you want a financial advisor, which according to the survey, 39% of those who don't have one want one, you're going to have to do the reaching out. You're going to have to do the vetting. The reality is most people in our positions, most financial advisors, aren't seeing the bigger picture yet, which is a real flaw of our industry. It's a real weakness. We're not sitting here just patting, you know, all the financial advisors on the back saying, oh, if only people would listen. No, we're not doing enough. Our industry's not doing enough. You're going to have to reach out. If you're the person listening to this podcast and you want an advisor, you're going to have to do the reaching out in more cases than not. And that's something you need to be thinking about how you're going to do, whether it's going to a Wells Fargo advisor or even reaching out to us. I mean, we can throw up contact information on the video, whatever it may be, and it doesn't have to be just investing advice. If you're saying, hey, how do I make a budget? Reach out to us. That's what we want to do, because the reality is people are not doing enough of that on the advisor side. It's not necessarily young people's faults. I mean, there was a period in which, you had the rotary dial phones and the brokers picking up and calling everybody nonstop, and whether that was good for business or not, everyone was a potential client. And that era is just done. People are being so much more selective in the clients they pursue. They want to know how much money they can make off of a client immediately. And the reality is, if you're a millennial and you're getting support from other people and you don't really know what's going on, and there's a 40% chance that you're not happy with your life in general, you're probably not a big profit center to most advisors. That's not an insult. That's just how they're viewing you. Find an advisor that wants to help you.
Yep.
We'll kind of leave it there. But yeah, if you have questions, I mean, that's what we're here for, whether it's something that could be answered on a podcast or something you need to email us. Hit us up. Happy to help in any way we can. Thanks for being here. Hey, everybody. Welcome back to What the Buck, this segment when we talk about things about money. Glad to be here. Low ratings. Ben last week had to impersonate me because I'm a ratings machine, but now I'm actually here. Glad to be here. Joining me, Sam Frost, Matt Krebsbach, Ben Nye. How's everybody doing?
Great.
Good.
Well,
electric crowd here as always on the Young Bucks show. Jumping right in, these two guys over here, Ben and Krebs, just got back from, I'm going to call it the Gibby Conference. Is that how it's pronounced? G-I-B-I? The Gibby?
I think they say Gibby.
Gibby. Soft G. Talk to us about the Gibby Conference all the way over in Dallas, Texas. How'd it go? Impressions? Any ideas stand out to you guys?
Yeah, so let's just lead off with the first one, which was Intel. Michael Price was supposed to present that. He said it has essentially a low valuation because it has a low price to earnings ratio. He also said that it has a high dividend yield, and then they moved on to the next person.
Hot takes.
Yeah. The next guy was Ackman, and what's really interesting to me was just how many people were surrounding Ackman at the beginning. I mean, it was like he had an entourage around him.
It was a legit posse that followed him as he was walking in. It's kind of cool.
Ackman's Backman.
Exactly. And he was talking about the stocks that he owns. So he talked about ADP. He thinks that's a $225 stock. He thinks that the margins have dramatically underperformed what they should be. And he said they dramatically underperformed the competitors. Obviously, what has been in the news lately is that the management team's come out and said Ackman doesn't know what he's talking about. So it'll be interesting to see how that fight progresses. Ackman's obviously had some very large successes. He's also had some very large failures. He did not talk about Chipotle at all, which kind of surprised me and also disappointed me because I think that's probably the one that has the most opportunity at the moment if he is correct.
And that's one of his newer names in his portfolio. And like you said, he's lost a lot of money on it. I mean, I'm also disappointed that he didn't talk about that. Out of like the 5 stocks he owns, that'd be the one that I'd want to hear most about right now. I mean, he talked a little bit about Herbalife kind of generally, but
yeah, and I mean that was really because he was asked about that before, and he blamed Carl Icahn for coming in. He said that it is a fact that it is a pyramid scheme, which I don't know how compliant that is. Andrew's our chief compliance officer, so I don't know if
I'd probably look the other way, but I don't know if a good compliance officer would. I don't know that you can really call that a fact.
Right. So that was Ackman. After that, he also pitched Fannie and Freddie, which he has been in for a long time. Says that's a lot more risky. ADP sounded like it. He thought it was his best idea at the present time. Fannie and Freddie has potentially the best risk reward, but the probability of failure is still significantly high.
Yeah, he made it clear that wasn't for everyone, which I respect.
Exactly. They also had some panels come up, but the other people who had the most actionable ideas were a guy named Russo, who likes Wells Fargo because it has the capacity to suffer. His big point was that Wells Fargo bought Wachovia and dealt with 7 years of pain, and now once they emerge from this cultural bad times, they're going to come out with much stronger earnings profile, much stronger company. He says it has a lot of upside still. Last few, chap named Wellington, he pitched AMG and Flex. These both companies which trade at low PEs. He thinks that they can improve. His rule of thumb is that look at the earnings power 5 years from now and give it a 9 multiple, and that's where the stock should be trading. So he likes those two companies. And then the last guy was Einhorn, who is trimming out of some GM, but he still likes the company. He's trimming out of it because it's just become such a large position because it's actually done pretty well, especially in the last couple months. His short basket has not performed well, and he was very forthright with his failures year to date, which I respected. And then his big new idea, which unfortunately only talked about for about 90 seconds, was Tempur-Pedic, or Tempur-Sealy as it's now called. Basically, they lost a contract with Mattress Firm, but what people found out was that Mattress Firm sales actually went down 15%, and Tempur-Sealy's was actually relatively solid. So he says that this is emblematic of a really strong brand, and he thinks that the company's earnings power is strong and could reach the high fives in a couple of years, which would obviously result in significant appreciation in the stock price if that can be achieved and the price earnings multiple stays constant. But I think he would argue that there should be some expansion there too.
It was a pretty simple pitch. Like, he has that one, those like two pillars that the pitch basically rests on. So, it's an easy one to understand. I'm pretty sure that was the first publicly he stated he was long Tempur-Pedic, right? So, right when he said it, like, it was funny, like the entire symposium, like, wrote it down on their notes and started taking notes, like, really fast because everyone knew it was a new idea. And I think it didn't go up that much today, but, it was an interesting idea. I haven't looked at it because I just got back an hour ago, but something I'll look into.
Slacker.
Yeah.
So some great investors had some big ideas, some best ideas. Jibby Conference, that's what it stands for, I think. So good stuff. We're going to put some more in-depth analysis on a number of these ideas on our Seeking Alpha page, so you can check that out. We'll have the videos on the YouTube channel, so youtube.com/Tusk Media LLC. We'll have all that in there, and more commentary on some of these things from Ben and Krebs. Transitioning just a little bit to a bunch of different random ideas that we have. The Equifax hearing was going on today, meeting with the Senate Banking Committee, something like that. Big headline really was that we had the Monopoly Man there. Sitting in the background, had the mustache, the monocle, wiping his face with dollar bills. Hopefully we can get an image on here. I have a lot of confidence in our media intern, Reggie, to make this happen. But Sam, thoughts on the Monopoly Man making his first public appearance in decades?
Yeah, I was happy to see that. It's been a while since we've seen him, I guess. I personally haven't seen him since I was like 10, 11 or so I was happy to see him. Brings back good memories.
What's it, Uncle Pennybags? Is that his name? So glad to see that guy getting out. Yeah, I think he's Uncle Pennybags. So kind of interesting. Equifax was up today. Kind of this continued fallout. These hearings I always find a little bit interesting, and I didn't follow it super closely because it's a really great opportunity for people who are politicians by trade to come out and act like they understand other industries and say things that sound really great, to the public without really doing anything other than reading like a few Wikipedia pages. So I'm sure there's some like hot button issues that if you're not informed, probably sounds like, oh, these guys really roasted that guy over the coals. But the reality is the stock was up some today, and it's actually rebounded a little bit. I think it's around 110, 111, something like that. I don't know if anybody has anything to add there. No. So now to the important part, football picks. Right now, Ben's allegedly 16-6. Myself, Krebs, and Garrett, who I don't even really think anybody knew was playing, we're all 14-8, and Frosty over here, 11-11.
Yeah, I want to protest these. I actually think that
there was some confusion about the current standings, so we reserve the right for those to be inaccurate, but that's where we're at right now. This week we're looking at Georgia, 17.5-point favorite against Vandy. Washington is a 27.5-point favorite against Cal. Wisconsin's a 12-point favorite against Nebraska. Bama, a 26.5-point favorite against A&M. And then the really big game that everybody's talking about is unranked Michigan State versus number 7 or 8 Michigan. Michigan State's a 10.5-point underdog. We'll jump up with the Georgia game. Georgia is favored again by 17.5 points, taking the dogs, which is a lot better than Vanderbilt. I think Georgia's kind of due for a letdown game, but they actually lost to Vandy last year, so I don't think it's going to come here. Vandy's going to have a really hard time scoring points. They're in the bottom quartile of pretty much every offensive category, and Georgia's defense is number 3 in the country. So I think Georgia will cover this.
Yeah, I think Georgia's got this one.
I think Georgia's defense is overrated, but I'm still taking Georgia.
Hot
Whoa, that's a hot take. That's Kirby Smart you're talking about.
Yeah, overrated defense.
take. Number 3 defense in the country against the number 10 schedule in the country, but probably overrated. Ben?
I'm taking Vanderbilt because I kind of what you were saying. I think they're due for a letdown.
Yes, I can catch up here.
Right. Next up, we got Washington, 27.5-point favorite against Cal. Talk to us, Ben.
Yeah, there's no way Washington covers that. I don't think. I think they've. Browning looked. I mean, the slow starts for Washington.
Big game, Jake.
I mean, it's been rough, the slow starts, and I also think that Wilcox has a very good defense at Cal, and I think that it's going to be a lower scoring game, especially in the first half, and I don't think they're able to run out the score in the second half to cover that spread.
I got Cal.
I got Cal.
Cal.
All right. Whiskey, 12-point favorite against Nebraska. Another unranked team for Wisconsin. Still waiting on that November 14th date with Michigan to play a ranked team. Krebs, talk to us.
I think this is a pretty sketchy game. I mean, 12 is. I mean, that's not that many points, but it's at Nebraska. Nebraska's 2-0 in the Big Ten. Granted, they've beaten Rutgers and Illinois, and they're like the dumpster of the Big Ten. Wisconsin didn't look that good against Northwestern. I mean, they're up like 24, and then they just kind of let it slip away and won by like 6. But I'm still taking Wisconsin with that. I'm not comfortable with that.
I got Wisconsin as well. I think Nebraska's kind of in shambles. I think they're going to get Scott Frost as their next head coach, though. Pretty pumped about that.
I got Wisconsin.
I have Nebraska, actually.
Ooh, little Cornhusker. They've sold out every game since 1963. People forget that. Bama, 26.5-point favorite against Texas A&M.
Yeah.
Sam.
Yeah, I don't think I mean, obviously, I don't think Alabama's going to struggle with them, but I think that they are kind of due for a letdown game because they've played like perfect the last couple of weeks, and so I don't know how long they can continue doing that, and so I chose A&M.
I got Bama.
I got A&M.
I have Bama as well. I think A&M still is riding the coattails of Johnny Manziel era. I mean, he's gone. Like he left a long time ago.
A&M struggled mightily with South Carolina.
I mean, that seems like a lot of points for a game at College Station to me.
The Alabama offense, from my perspective, is the best the Alabama offense has been in the last.
Yeah, I'd agree with that.
Since Saban got there.
Yep.
Which is just kind of scary because we've talked about this before. Normally, the defense is stout and they make a lot of plays on defense, score a lot of defensive and special teams touchdowns. But now it's like, no, the offense can score.
That's what we talked about last year. It was almost like every game the catalyst was a special teams or defensive touchdown or something like that. Mm-hmm. This year, the offense is actually making plays.
Yeah. Krebs, talk to us about your bonus game for the week.
Yeah, so I'm really excited about this one. Primetime game, Michigan State at Michigan. Last time this game was played in the Big House is when that block punt. Do you remember that play?
I do.
Michigan blocked that punt, or Michigan State blocked that punt with like 10 seconds.
When they blocked the punt.
So they blocked that punt and
recovered
and they won the game with 10 seconds left. I think Mark D'Antonio is a really underrated coach, so I think he's going to keep it close, but I'm still taking Michigan there.
So real quick,
to cover 10.5.
How on earth? I mean, I've got Michigan State for what it's worth. So Michigan State plus the 10.5. How did Michigan State go from like 12 wins, 13 wins, appearance in the college football playoff to 3-9 in 1 year? How did that happen?
They lost a lot of talent.
Well, yeah, but like that's unreal. Like to have 3 straight years of 12 wins.
This is the rebound. This is the rebound season.
All right, but not enough of a rebound.
I got Michigan.
I have Michigan too.
All right. So I can make up some ground there.
Yeah, you're welcome.
Very good. All right. I think that's all we got. Y'all have a great week. Check out all our segments. Share them. Check us out on iTunes. Just search Young Bucks. Subscribe. Leave a 5-star review. Download, delete, re-download. Helps our numbers. Y'all have a good day.
Hey, everybody. Welcome to Getting Tanked. This is the segment where we talk about stuff in front of a fish tank. I'm Sam Frost, joined here with me is Andrew Hall. How's it going?
Doing well, man. Doing well.
Good deal. So today we're going to talk a little bit about baseball, a little bit about investing. So the Wall Street Journal came out with an article, I believe it came out today, titled "The Downside of Baseball's Data Revolution: Long Games, Less Action." And so bear with us. This will tie back into investing at some point.
People probably would rather hear about baseball than investing, if we're being honest.
Yeah, so sorry. We'll give you a little teaser. But so anyways, basically the bottom line of this article is the Moneyball revolution happened a couple of years ago, and all of a sudden you got smart people trying to figure out the statistics and the strategies and all this, in-depth data analysis of how to win ball games. And so it says here in the third paragraph, baseball has never been more beset by inaction. Games this season saw an average gap of 3 minutes 48 seconds between balls in play, which is an all-time high. There were more pitcher substitutions than ever, the most time between pitches on record, and longer games than ever. So what we're trying to do right here, we're going to tie this in, is that you got baseball who they're collecting all this data to try to make the perfect decision in literally every pitch of a game. It varies like, count, you got David Ortiz up. He's a heavy pull guy. You got this huge shift, right? And I guess David Ortiz didn't play this year, so he retired last year. Not a great example. But
everybody loves Big Papi.
But everyone knows Big Papi. And then that strategy, that same shift might change when he has 2 strikes on him. And so it's literally pitch by pitch. They decide how to do these shifts and stuff and what pitcher should pitch to every single batter and what situation and everything. And so what's happened is baseball games are getting very long and drawn out. The MLB is worried that, fans aren't going to be attracted to the games anymore. They're going to, lose revenue. It's going to, what sparked the revolution could also be the downfall to baseball.
Right.
And so how we're tying this into investing is it's very similar in that there's so much data out there. You got the Bloomberg terminal who's just feeding you live information all day, every day. You get updates on news articles and everything. And so you're just trying to fish through all this data, put it together, come up with the best idea. However, the time that it takes to put all that data together, unless you're a quant shop, could take some serious time, and you can miss out on some good investment opportunities. And so I think about, a company, all of a sudden an article comes out, company goes down by 10% that day or something. Now you're like, okay, I need to analyze this company and put it all together. Does this make sense? Is it still a good investment? Is this an opportunity? By the time you fish through all that data, that could take you weeks. I mean, especially if you're just like a beginning investor, you're looking for ways to invest, and you want to really make sure it's a good investment. You might miss that opportunity.
Yeah, and it's even more complicated than baseball in a lot of ways, which, you almost think of it like this. You have a certain batter up and he has a certain weakness. You want to exploit that weakness, right? That's kind of what you see when the stock trades down. Well, imagine if you had an infinite roster of pitchers.
Right.
Which is not the case in Major League Baseball. You have roster limitations. There's only so many guys in the bullpen, so many scenarios that you can run through. You run through those 5, 6, 7 guys pretty quickly. You can kind of figure that out. And, yeah, maybe you do have that 3 or 4 minute lag between balls in play, things like that. But in investing, there's so much more data there, and you can miss that opportunity. We tend to call that, there's a number of different terms for it, but we call it paralysis by analysis.
Yep.
You spend so much time analyzing this wealth of data, learning everything you can, that when push comes to shove, you don't have time to do anything.
Right. And so what we want to talk to you today is basically about rounding out a quick, efficient approach to investing so you can feel confident in every decision you make. And so something we actually do here at Narwhal is we follow a rubric that basically grades companies on certain topics.
Right.
And so basically what we're trying to do is just give you a little outline of maybe how you could look at a company in any situation and feel confident in your decision and not think, I shouldn't pull the trigger. I should wait until I do more analysis, and then you miss out on the opportunity. So, Andrew, I don't know if you want to just start off talking through this a little bit.
Yeah, so one of the big things we look at is management. And I should say this as a caveat to this. This is not the only thing we look at. We tend to, after going through this rubric, we'll assign valuation targets and action points in terms of, when do we want to throw, to the inside corner of the plate versus the outside. We do other steps, but this is a great way to quickly get our bearings, quickly understand where we're at, and in a reasonable amount of time be able to move towards a decision.
Right.
So the first thing that we tend to look at is management. And we kind of have this rubric. We grade everything out of a total of 40 points. This is a 10-point category. So it's a heavier weighted category because we think the people that are in charge of the company obviously have a lot to say and a big impact on what's going on.
Right.
So there's a lot you can look at here. You could look at everything from, how much do these people make? Is it fair to the rest of the industry? To historical success. Are they buying companies, and is that succeeding? Or you can look up some really easy metrics, and a great one on those, I think, is ROIC, which is the return on invested capital. If you're at home and you can access Google Finance, Yahoo Finance, any of those, You can search a ticker and usually type in ROIC and pretty quickly find that number. And that's a great way to kind of get a bearing. And you can look for an industry average. But what you're wanting here is a number that's higher than average.
Right. So you want a number that's higher than average, and to get a little bit more granular, you want an ROIC that's greater than your cost of capital, which is your WACC. So a lot of these websites as well would also provide you with a WACC, or you can look that up and kind of get a rough idea of what it is, which WACC is WACC, weighted average cost of capital. If your ROIC is greater than that, then they're basically generating positive economic returns, which means real money. So like,
think of it in real world terms. If I can borrow money at 5% but create a return of 6%, at the end of the day, that's a good transaction for me.
Right.
Is it the best possible transaction? Well, maybe not. Maybe Sam borrows money at the same 5% and can get a return of 8%. He would be the better investor.
Right. And so this ties into management because they're obviously the ones determining the projects that they're investing in that generates these returns, ideally positive ROICs greater than their cost of capital.
Yep. Next thing we tend to look at, and again, there's tons of things you can come up with. I would encourage everyone to come up with a list of 5, 6, 7 things, whatever it may be, and stay disciplined. I think that's the big key here, is to be disciplined, so that when you're in a pressure situation, you're not treating a company different than other companies are. So another thing we look at is accounting. We give this a 5-point emphasis, again, out of 40 points total. Here we're looking for a couple things. We look at cash flow in terms of what they're generating. We look at payout ratio. But a big thing we look at, and Sam, you can talk some on this, is what adjusted earnings per share look like versus GAAP earnings per share.
Right. So basically, from a 10,000 foot view, GAAP earnings or GAAP EPS is the company can't make any adjustments, obviously.
Right.
And so that is like the best reflection of how much money that company earned. In that GAAP number, though, there's going to be items that the company deems or management deems that are one-time events, things that aren't going to happen. Maybe like we just had Hurricane Irma and Hurricane Harvey. Maybe that stuff comes through, it affects some profits or whatever. Management's like, hey, that's a one-time thing. That's not going to happen again. And so they make an adjustment to tweak for that. And so, and it helps analysts in that analysts, they can't predict a hurricane is going to come through and affect something, or maybe some crazy one-off lawsuit comes up or whatever. So they can't quite predict that. And so it's to help analysts get a better idea of how the company's going, because you can't predict those one-off events. However, that leaves room for management to tweak their numbers, to sit here and like just deem things that they want to as one-time events or whatever, to bump that EPS up to what they want it to be, what analysts expect it to be, so the share price doesn't get hit. And so what we look for is the gap between the GAAP GAAP between GAAP GAAP EPS and adjusted EPS. And the smaller that gap, the better, because that means that management's not making excuses. They're giving you the numbers as they are. They're not, making adjustments to try to meet Wall Street. And so you have less chance of being blindsided by management being like, all right, you know what, we've been screwing up. And so this also ties back into management. The first thing we talked about, how much can we trust management? And so those both kind of go hand in hand.
And a great way to think about this is on a personal level. Let's say that over a quarter you made $10,000 in income, and at the end of it you've got $1,000 left. You would say that, I spent $9,000. That would be your math. And you would say, okay, well, I saved $1,000, and so really $1,000 is my personal earnings. After all of my expenses, I have $1,000. And then you may look through those expenses and say, well, my grandfather passed away, and he's my only remaining living relative. It's very sad, but he's my only remaining living relative, and I flew to his funeral, and that cost $1,000. So really, outside of that $1,000, I really saved $2,000 because that was a one-time isolated thing that won't happen again. That's kind of the illustration because, on a true GAAP basis, you'd be at $1,000. Right. But you're going back and you're kind of revising and saying, well, really, it would have been $2,000 in a normalized period. We'd rather say, no, what actually happened here and how close can we get that gap?
Exactly.
Next thing we look at is theme, which we don't have to spend a whole lot of time on. This is much broader, but this is kind of the macro trend. This is a 10-point item. We tend to look for, industries that are growing, that are changing, that are evolving, not industries that are dying. We will invest in companies, maybe in dying or fading industries, but we're going to give a benefit of the doubt to a company that's in an industry or a theme that's really growing and taking off.
Yep.
Catalyst and risks is a little bit of a more micro look at this. And so this is a 5-point item. But here's where we kind of look at specific events and actions that may be coming up to really drive the company. And the important thing here for us is to look at both catalyst and risks and weigh them equally. It's easy to say, well, here's this company and here's the upside, but have the integrity to look and say, well, here's the downside and how close that could be.
Yep. And if you look at a company and you think there's zero downside, chances are you missed
You're wrong.
something. Yeah.
Yeah.
So maybe you need to go back and look.
Yeah, that's a quick way to know you're not ready to invest is if
Yeah.
you don't see any downside to a company. The last thing we have here is the company's position, and this is where we really look at things like a moat. And when we talk about a moat, what we mean is how hard is it for someone else to come in and compete? Is it very difficult, or could somebody decide tomorrow that, hey, I want to get into this and do this? Does this company have any pricing power? How strong are their assets? What's their return on assets? How are they doing? What kind of leverage do they have that other people maybe don't?
Yep. And so, I mean, just to wrap this up, we're basically encouraging people or anybody watching this show is come up with a list of things that you think are important to investing in a company, and then weight them to what you think is the most important, least important, or you don't even have to weight them. Just some way to scale or to grade a company, like within you sit down, you do research for an hour. And then all of a sudden you feel comfortable that you can say, yeah, I trust the management. I feel like the accounting measures that they're reporting are accurate. And, whatever you think is important, rank it.
Yeah, and come up with a way you can measure these things. I mean, I think that's really important. It's way too easy to decide, hey, I want to invest in company XYZ and go in and find, kind of these qualitative, softer things that make XYZ seem like a good investment. We could make a case for investing in any publicly traded company if we really wanted to. The truth of it is, though, most of those are not companies we actually should invest in.
Right.
So do that. Stay consistent. Stay disciplined. And, have a way that you can kind of process information in a reasonable amount of time. And this kind of ties back into the discussion we had earlier about advisors. This shouldn't be your full-time job unless you're working in this vocation. We are not suggesting that you spend your nights and weekends researching the stock market nonstop every day. If that's something you're passionate about, great. If not, honestly, find an advisor, but hold them accountable too. Find out what their process is. Mm-hmm. Make sure they're disciplined, because if they're not doing this for you, they're probably not worth the fee you're paying them.
Yep.
There you go.
Thanks for getting tanked with Sam and Andrew.
Woo!
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.